This is Satya Pradhuman of Cirrus Research, and welcome to our quarterly market call. A lot of the comments and observations made today, a bunch of this will be taken right out of our quarterly. That's the dispatch. That report just recently came out. The title of the report, Dovish Fed and Stabilizing Profits Drive Markets. And broadly speaking, this is definitely more of a constructive outlook on equities. There's some real nuance, though, to this call, the idea of leadership and the risk of a change in leadership. So we'll be walking through really how we're framing out this current environment. Just some housekeeping here. As some of you are aware, the website, the Cirrus Research website, has been upgraded. You guys now have access to our research archives going back for over 15, 17 years. In addition to that, the YouTube channel continues to hum. We've been adding very select pieces, very short cuts of interesting research that we're publishing. So that's been super. The feedback's been very, very good there. I definitely urge you to take a look at that. And then finally, every quarter or so, we do publish a podcast that's out on the usual places like Apple and Spotify. So let's get into it. Again, this title, a fairly constructive equity market. What we're going to cover today, we'll talk a little bit about the earnings cycle and how that's really good for, generally a bottoming profit cycle is good for equity valuations. In addition to that, it is also implying more of a broader leadership, very counter to what we've experienced in the last 15 months or so. This idea of a dovish Fed speak, maybe that just got upended with the hotter than expected inflation report today. But nonetheless, I do think that we have an interesting backdrop that's terribly constructive for the cost of capital. How does this play into speculative leadership, and how does this evolve? We'll talk a little bit about how maybe the AI craze really gets broadened out to sort of like, as we're sort of calling it the Ozempic miracle. So we'll talk a little bit about the state of speculative leadership and how this evolves. Tactical concerns clearly are abound. I do think this idea of crowding, our models have flashed red, and then yet there's still some counterpoints to this as well. So we'll get into that. And then really, how does this market sort of evolve as we get through potentially this Fed pattern of coming to support? We'll talk a little bit about the industrial picture as well as a whole. And let's jump into it. The first set of slides in the report, really we get into this idea about the cost of capital. And I think what's really jumped out at us in the last, I would say 12 months or so, has really been the terribly constructive credit market backdrop. When we look at high yield spreads, except for the sort of regional bank breakdown last year in March or so, we've really had this glide path of easy capital. What we like to look at is, of course, the high yield market, the credit spread relative to treasuries, but we also want to go a little deeper and say, what about the real, deep cyclicals? So what we've also looked at are spreads like building materials, bank spreads. These things are all, in fact, if anything, maybe even more constructive. So the idea here about capital and access to capital, I think, is very constructive for the profit cycle. In addition to that, if we look at where we are in the last couple of years of the profit cycle, I think what's very compelling, and we tend to use top line growth because it sort of avoids the noise of earnings and earnings management. The heart of this is that you've had, as the Fed began its sort of tightening movements in the last 2-3 years, what we've seen is top line growth really roll over sharply. And, as a result, the profit cycle did slow significantly. What's important, though, is that we're getting hints of a bottoming. We've been definitely seeing this. If we look at estimates the last 6 months, those sharp cuts that were sorely needed as the Fed began their tightening pattern, those spreads started to finally bottom by last summer, last fall. And so what we're now seeing is, more about, instead of having 60, 70% of estimates with cuts, what we're seeing now is more of a 50-50 picture. So we think that we have more of a stabilizing earnings pattern, if anything, one that's somewhat constructive. And so this, when we step back and look at this idea of growth and earnings growth, the idea of a rate of change where you've had this massive pullback in growth, couple that with easy capital tells us that if we look forward, we basically see a fairly constructive picture for the profit cycle curve. This, as much as there's so much going on in the world and in markets, we do think it's terribly important to simplify the goals, and that is for businesses to do well, they do need capital. For investors to do well, they need reasonable valuations and all around easy credit. And so what's curious about this moment is not only is the capital markets easing, and what might be very constructive and at the same time disturbing is the Fed looks like it's about to also ease. So if they begin to unwind and begin to cut their short-term rates, this creates a terribly liquid, buoyant capital markets situation. And to some degree, this is hard to fight given the sort of signaling we've had. Today's report maybe suggests that there will be more debate in that room as they come out with their decisions. Maybe there's some date shuffling. I got to caution you. I think we go back in March, April of last year. Just bear in mind, the consensus sort of believed that because of the banking crisis that was brewing or feared, that the Fed had already gone too far. And by the summer of 23, we were going to get some cuts. So markets have been wrong before. We do think this is what stacks behind this idea of sort of like paying attention to valuations, because if companies are growing profits, the more important thing to do is to search for those firms where you can get growth at a reasonable price. And so stepping back more broadly from the global work we do, the credit picture is consistent. Clearly, the US probably has some of the best standards, but what we're seeing even in Asia and other key markets are spreads that have backed away from the very, very scary levels they were a couple of years ago. If we look at also to Europe, it seems to be tracking very nicely with the US curves as well. So this picture is not just a US-centric view. And I think it's very important to understand that the global profit cycle appears to also be bottoming. So bearing that in mind, let's think a little bit now and shift over to sort of the US sort of speculative trade. And we sort of hinted to suggest that given what the Fed is signaling about cutting short-term rates, we can't help but think the sort of Nifty 7 performance that we've witnessed in the last, I would say, 18 months or so. It's hard to get in front of that if the Fed is also going to begin to cut rates. So this idea that we've got this AI-driven leadership, it's effectively been an NVIDIA trade. What this says with the credit story is that you've got yourself more of a glide path here that meets the eye. Importantly, though, if we look also to healthcare with Lilly Novo, those stocks have also jumped sharply in the last year. Lilly's up, I believe, over 140% or so, and Novo is roughly about 70% up, well past the healthcare proxies that we're looking at. And I think this is important to understand that the investment community, the speculative run, is not your traditional speculation where it's going after all of the tiny biotech firms that are out there. And not every new AI potential company or firm that's calling themselves AI. It's being a lot more selective. It's looking at fairly sizable firms with real footprint. And I think this is the stuff that could stick longer. We do have some telltale signs of caution. At the heart of this, if the 10-year begins to back up more, this is a real problem for the highest multiple stocks. So it is something we're going to watch. Just bear in mind, really from March, the 10-year has backed up by about 55 basis points. Today was about a 20 basis point jump, at least as of this hour. Something that we'll watch. But I think what we're saying here that's super important is to bear in mind that there's speculative fervors underway. We do have a crowded market, especially in the tech space. So to see this thing extend out to another potential technology jump, it would be very natural to see this occur, especially if we've got more of a dovish Fed. Um, to put this sort of run of some of the large healthcare names relative to the Nifty 7 in the last year, Lilly, Novo, they've outperformed the basket of the Nifty 7. I think some of that is being weighed down clearly by Tesla and Apple. But nonetheless, I think this speaks a lot about what's going on with the ability for the market and investors to take on speculation. One reality check in terms of the sort of focus on AI is to look at the broader sector multiples, that if interest rate risk is abound, what we're looking at going back for decades is the technology sector multiples are hitting some record peaks relative to the overall market hurdles. Healthcare, on the other hand, has been pretty much the exact opposite direction. So if we do get a sense of some special drugs that are surfacing and the market begins to chase them, there's a lot more of an opening to see the healthcare speculation run much harder, especially in the face of interest rate risk. So this is something that I think further makes our point about speculation of where it could go. Let's now get down to some of the reality, though. We have really modeled this idea of crowding over the years, and we think it's terribly important to be focused on. Another way to think about this, our CPQ, or the Cirrus polarization quotient, and it is a proxy for crowding and FOMO. At the end of the day, what this model can show is that how much are we willing to pay for stocks that we love? And what we've learned over the years is somewhere between parity and let's say a 60% premium is normal. Once we cross that, which we did about 3-4 months ago, we begin to enter into a very volatile territory. So the crowding measure, if we look at the baskets of leadership today, nearly 50% of that basket is dedicated to technology. So we clearly are in a unique zone, and that is why so many investors are nervous. Go back to the earnings season. How many people were nervous, and everyone was watching the NVIDIA earnings report, right? And I think, make no mistake about it, we're going right back to that in the next few weeks as the next quarter report starts to roll out. People are terribly nervous, and we've seen this before. You go back to the 2000 era. There were plenty of investors nervous about Qualcomm's earnings report around the height of that run. So I think we've seen some of this before. But what is different about this is that not all of these triggers seem to be climbing quite the same way. One pairing of a model is also the risk appetites in market. And what this is registering is a more benign take. And so our risk appetite model, we call it the Cirrus risk score, or the CRX, that reading is in fact benign, and it has begun to ramp up. But what it's telling us is that we're fairly, there's quite a distance between where it is today and where it can cross for us to begin to say, okay, this is a speculative moment. The last time we got this, where both readings sort of pierced their extremes, was back in really the fall of 2020. Both the crowding measure and the risk appetites had broke through, signaling a pretty awful break in leadership for the next 12 months or so. So our point is that it is troubling to sort of deal with this idea that you've got a crowded market, we're not comfortable, and at the same time, the fundamental reports continue to come out strong in terms of the AI spend. So it's very hard to go in the face of that when our risk appetite measures are also suggesting that we've got room for this thing to get a lot frothier from where we are. And so that is this sort of moment that we're in. And then the punchline to this is the Fed. I was personally a little surprised that the Fed came out so wholeheartedly saying they've got to reverse rates by the back half of this year. I think this latest report that we see with the inflation data suggests that maybe they were maybe a little too forthcoming. To me, in a services-based economy, to see such a low unemployment rate, it is awfully hard to believe that the inflation data could be so well behaved. So, what's this transition picture and what could go wrong? Well, a hint of this is what you're seeing from our Cirrus style oscillator. In the last 6 months, this reading, mind you, in the last year or two, and then going back the prior 2 years, we saw a massive growth bias in that oscillator. Today, what we're seeing for the first time in nearly a decade is an overweight to value. That is shocking. I mean, even in the reopening trade, this reading was a lean value, not an overweight value. So something's going on here. I do think that one, underneath this model, it really depends on credit. It also depends on the profit cycle, and it's a contra signal, meaning that whenever the profit cycle's ugly and looking like it's about to rebound, this thing goes heavily into value. Also, whenever credit spreads are narrow, it starts a hint that the growth rates coming out of the companies should be strong. Again, another reason to be value centric. So, moral of the story is that some of the oscillators hinting that this idea of a speculative leadership is probably running long in the tooth. And we are likely to see some sort of rotation. Um, what's interesting is also a proxy of high quality that we made a call a couple of years ago, really the spring, summer of 21, to begin to lean in the quality. We were literally sort of reacting to the sort of reopening of the economy. And back then, we were also reacting to the fact that the Fed was very vocal in saying they were about to begin to unwind their easing process. And so that really led us to think hard about this. What also pushed us into the quality bias, though, is that higher quality stocks have gotten beaten up badly. At first, with the going into the pandemic, with everyone going into the at-home stocks. Traditionally, if the economy was slowing, we would have paid up for food, soaps, what have you. In the pandemic experience, we were paying up for Zoom. And so the quality stocks really lost ground in that initial shutdown. And as we went into the reopening, the quality stocks, high quality, got really penalized. So what we were witnessing, massive underperformance of quality. And what we've seen since then, really as the Fed enacted their tightening policy, was the quality baskets really started to work. In the last 6 months, they have begun to stall out. So this is a further piece of evidence that's telling us that if we think the profit cycle's is bottoming, we also have evidence that the market's not paying up for quality the way it did the last 18 months. And in fact, if we look at where the valuations are for certain groups, for instance, the mid cap and also the larger cap area, their multiples are nowhere near as discounted as they were back in 21. And so while the higher quality firms can get more expensive, at least in the large and mid cap arena, it does seem as if that this sort of like movement confirms the idea that we're likely to get more of a value centric investment market. Bear in mind, I don't think anybody goes after crappy firms. That's not really what I'm saying here. But what I do think is that there is a premium to higher quality firms, and there are periods where you don't have to pay up as much to get growth. And I think if the profit cycle expands, that's effectively what this is saying. So in terms of portfolio construction, we've got to think more about valuations becoming more of a component in our decision making. In fact, if we look at active returns, super interesting material that's surfaced in the last year, something that I'm not sure that's very common. What we're witnessing, whether we look to the growth side of the equation or the value side of the equation, and valuations or momentum, what you'll see is that in the smaller cap arena, if we paid attention to valuations, it worked. In other words, that the performance of undervaluation versus overvaluation, that spread is favorable. To no surprise, in the large cap benchmarks, it's exactly the opposite. There's almost a 25 percentage gap in performance in the last year or so if we paid attention to valuations. This is not a surprise. We do know what active manager results in the large cap growth camps being. It's been a very tough benchmark to beat. If you're going to promise diversification and well management, and then only 7 stocks in your entire benchmark's running, that's a problem. And if we look in the smaller cap arena, on the value side or trending, what we'll see is also that the trend factors have worked both in smaller and larger firms, but clearly trending in the large cap arena has been very strong. What's this current environment? What does it mean going forward? Well, what we think is that if the Fed continues to deliver on what it's promising, we'll probably see more focus on trending in large cap growth. But this market, like it or not, it is already broadening. And so the question is, how far does this climb? My suspicion is that it goes back to the adage of buy on the rumor, sell on the news. In other words, if you look at the last 3-6 months or so, it has been a buy on the rumor for speculation that the Fed is coming to the rescue and firms already have very good access to capital. The moment the Fed begins to act is potentially a problem. Or maybe to this report is maybe the moment the Fed begins to second guess, that's really where we begin to see a problem for speculation. How does this play out? Why would markets price it this way? Well, think about it this way. If the Fed begins to cut short rates, we've got record low unemployment, we have profit cycle bottoming, we have credit markets that are easy. What does that mean for the long bond? The long bond will sell off even more. If the yield curve begins to go steep on us, then the highest multiple stocks are going to be severely at risk. And that is what probably crushes the speculative trade. My belief is that this probably runs harder into the next few months. We get a lot more speculative. My gut is the earnings report this season is going to be pretty good. So there is something to be said about immediate evidence that will quell the market's nervousness. So the idea of this sort of speculative run going a little harder, I think it does. We're not in the 9th inning. Maybe we're at the 7.5 inning. But at the heart of it, this is still a very difficult market to compete in the large cap growth arena. I think our active blends have done a pretty good job in the mid and the small cap area. It's not saying that our models are so special. What I'm saying is that most active managers in the mid and the smaller cap area have had a better go at it because fundamentals have mattered. Shifting gears a little bit, if we talk about a broadening market, we talk about sort of like a shift away from speculation. Where would we go? And we've laid a very good case in the last 2-3 years for industrials, the rotation in capital goods spending from a CapEx tech to CapEx industrials. This has been bearing out fairly well. The infrastructure baskets we've built, whether it's large, mid, or small, they continue to work. And at the end of the day, we think this is just beginning. A lot of our infrastructure case has been made on this idea about a regionalization of global businesses. We've definitely seen some reshoring going on. Some of that's really helped places like Latin America, India, ASEAN markets. I suspect this will continue. We've also talked a little bit about climate effects, infrastructure effects. I think the port situation in Baltimore is another case point on how spending will continue to move on the industrial side. I do think it's interesting that in the Cirrus infrastructure basket, so embedded in there are metal benders, but we also have semiconductors as well. So moral of the story is that it is not, the markets are complicated, but I do think we have pretty good evidence of an infrastructure build out, industrial build out, and fortunately or unfortunately, it does seem to be at odds with technology spending. In other words, CapEx is a till of money, and people got to spend it one way or the other. If they're going to accelerate their spending in tech, industrial spending will fall out, and vice versa. We've seen this before. And it seems to be happening pretty much since the reopening. What we've seen is the industrial spending has accelerated. Technology spending has sort of gotten flattish. Still noisy. Recent period has picked up a bit. But at the heart of this, the idea that if we do get this trade-off in leadership, the fundamental broadening we're witnessing right now could only accelerate. So this is a big deal. We've certainly put a lot of focus on it. The results haven't been bad year to date. The industrial sector has actually outperformed the technology sector. Now, granted, even within large tech, we know there's some very special firms that are running away with the market. But I think it's fascinating to see that take place in the thick of this sort of like, very focused investor community on AI and all things wonderful AI. One additional note here really relates to recent evidence, however. When we look at the market in the first quarter, what we'll see is speculative growth here as a proxy for, let's just call it technology. Uh, in the large cap arena, they've done very well. They're up about 14%. As a sector, the benchmark market really for the first quarter was up about 10, 11%, depending on whose market proxy you're using. It is very curious, though, that the industrial groups, the material groups, they lagged a bit, but they outperformed or nearly outperformed the benchmark up over 10, 11%. To me, that tells me there is change underway. And this is going to be something terribly important as we get into the fall, late summer, fall of this year, because this sort of one sort of chapter focus does seem to be a little bit of short-lived. If we look to the smaller cap arena, much more dominant real economy exposures versus the speculative growth. So this is something that I think is telltale. It's some evidence of this nature of change. So how do we put this to work in the portfolios? As some of you that are familiar with our material, we tend to run 3 different growth portfolios, and we run 3 different value portfolios. On the growth side, we'll run from one extreme, like aggressive growth, to the other extreme of quality growth, and somewhere in the middle there is GARP. Given what we've observed, what we think will play out, the GARP portfolio, we think, should do very well. What it will do is give you the focus on business growth, because the profit cycle is likely to expand if we get this right. And it also gives you some focus on valuations to temper the trending chase. If we're wrong, and this sort of speculative run is a lot stronger than we think, then the aggressive growth portfolio will outperform pretty much every portfolio we're managing. And that's to be seen. That was certainly the case in 23. On the value side, there's a lot of talk about the small cap run. There's a lot of talk about value working. We've got some evidence of it. I do think this is not exactly a classic deep value rotation. It's hard to make that call, right? Because in some of the most dramatic moves in smaller caps and value, they typically coincide. They're typically at a period where you've got a blown out economy and you got credit spreads that are terribly wide, and they begin to heal. That scary moment is really the precipice for a massive small microcap rally, a deep value run. That is not the picture we've got. And yet our style oscillator is telling us buy value. So what this basically says is that we could end up being in a broad leadership market with a much more valuation sensitive run. But I don't think it's a market of just deep cyclicals. I do think, though, it's interesting to see some of the deep cyclicals have really surfaced in the first quarter. I think that's super important. At the heart of this, though, our quality value and our quality growth models, those are great long-term proxies. They really serviced us well in the prior few years as the Fed ran its program of tightening. But I do think as of last quarter, we definitely backed away from that quality bias, and I think for very good reason. And so, in terms of, where we're at here, this is a very difficult period. As an active manager, especially if I were a large cap growth active manager, this is painful. The fundamentals are starting to rear its head. It is worth a chase after earnings growth. you could probably still do some benchmark protection here where you've got to own some of the Nifty 7, even if your discipline is really forcing you away from those names. The the point that we're making, though, is that the sort of a dovish Fed take, I don't think that's going to go away, and I think they are going to have to make a move at some point. We could see some delays, but that will extend this sort of speculative backdrop. Does it open up to sort of like, as we call it, the Ozempic miracle? Heck yeah. I think it's definitely something that we're going to have to watch. And for the folks that are very nervous about NVIDIA's moves, they they clearly will not shift gears completely and go buy small value, but they will probably buy Lilly. And so I could see this continuing to work very well. The tactical risks are abound. Make no mistake about it. I do think that the crowding measure is spot on, and it is allowing us, in terms of some of the portfolio work we're doing, to basically become a little bit more strategic in our weights, watch our valuations a bit, try to diversify it a little bit more. We're going to give up on some relative performance, but I think for long-term risk return comps, I think we're going to be the wiser for it. The risk appetites, I got to say, it is a little bit of a head scratcher that our risk appetites aren't further along. In fact, some of the global data we're showing shows that broadly risk appetites are down and they're starting to climb back up. This is not a picture I necessarily want to be underweight risk assets. So something to try to reconcile. At the end of the day, though, we do see the real 2-3 year trade in the making is this idea about an industrial sort of like broadening. It does effectively mean you've got a more cyclical take, you've got more valuation sensitivities. But bottom line, a constructive equity market, one that's much more nuanced than anybody's comfortable forecasting in. But we certainly have the job, and we have to do it. So yeah, take a look at the fuller report. There's lots of interesting details. We have portfolio samplings clearly that are going out to our clients. Do reach out to us with any questions. And thank you very much for joining us today, and good luck for this next quarter. Thank you.